I want to now take this basic accounting equation, which we've been discussing, and expand it to reflect changes over time. As we've discussed, the basic accounting equation of assets equals liabilities plus owner's equity is embodied in a company's balance sheet. That's one of the general purpose financial statements. At any point in time, the amount of assets, liabilities, and owner's equity represents the cumulative effect of all the company's transactions from the inception of the business up to that point in time. Now let me explain what I mean by that. Let's assume that we have a company that's been in business for 10 years, and on the balance sheet presented at the end of the 10th year, they have total assets amounting to $1 million. They've got some inventory, cash, accounts receivable. Total assets amount to $1 million worth of assets at the end of the 10th year. Now, that $1 million represents the cumulative effect of all asset transactions from inception. In fact, at the day of the start of the business probably had 0 assets. And on that very first day, they start with 0 assets, and then the owners contribute some assets, or they borrow some assets, and then they start operating and maybe start creating assets through profitable operations. And so over time, their assets have continued to accumulate such that at the end of the 10th year, they have $1 million of assets. And that's the amount reflected on the balance sheet at the end of the 10th year. That $1 million does not represent the amount of assets they got in the last month, or the last 6 months, or last year. It's the total amount of all of the inflows of assets, assets coming in, and some assets going out and coming in and going out, over the last 10 years, and this is the balance that we have on a running balance basis. Let's also assume that at the end of the 10th year, we have $600,000 of liabilities. Now again, these liabilities are the running balance of liabilities that are outstanding at this point in time. At the beginning of the business, we had 0 liabilities, and then we probably borrowed some assets, incurring a liability, and then we probably paid off some liabilities, borrowed some more, paid off those obligations, borrowed some more. And so I'm not talking about the total amount that we've borrowed and paid off. I'm saying that at this point in time, if you take all of the amount of obligations created as a result of borrowing, less payoffs of those obligations for the first 10 years on a running basis, at this moment, the balance of unpaid obligations is $600,000. It's not simply the amount of liabilities created in the last month or 6 months or last year. It's simply the amount of obligations that are outstanding at the end of the 10th year as a result of all the cumulative transactions for the last 10 years. Let's assume then that owner's equity, since assets minus liabilities equals owner's equity, and we have $1 million of assets and $600,000 of liabilities, that owner's equity amounts to $400,000. And again, we've said that owner's equity is created one of 2 ways, either through capital contributions from owners, sometimes referred to as capital stock, and by the business retaining any of the assets created through profitable operations or earnings, called retained earnings. Let's assume that, again, of the $400,000 of owner's equity at the end of the 10th year of operations, that's the balance outstanding, the running balance, that $100,000 of that represents capital stock, or in other words, contributed capital in exchange for ownership interest by the owners or investors. Again, that $100,000 is the cumulative amount for all of the 10 years combined. It isn't the amount that was just contributed last week or last year. It's the amount that was contributed from the first day on a cumulative basis, such that the total amount that owners have contributed up through the 10th year is $100,000 worth of assets. As a result of $100,000 worth of assets provided by capital contributions, the remaining amount of owner's equity, total of $400,000, or the $300,000 remaining amount must be associated with retained earnings. It is the amount of assets that have been created through profitable operations, but not profitable operations retained in the business for the last 6 months or for the last year, but for the last 10 years. This is the amount of all of our earnings less all of our distributions of those earnings to the owners, or dividends, since inception. It's a cumulative running balance. Okay, now let's go ahead and kind of move forward now, and I want to suggest that comparisons of balance sheet amounts from year to year highlight changes in a company's assets, liabilities, and owner's equity as a result of business activities during that particular year. These annual comparisons from year-to-year balance sheets can be very useful to investors and creditors in identifying past performance trends and can facilitate their projections for the future. You know, most investors and creditors are more interested in what the future holds than what's happened in the past. Now, what's happened in the past is important, but it is really important primarily because it gives us maybe some evidence or clue as to what the prospects are for the future. If I'm buying stock today in a business, what I'm really interested in isn't what the stock value was 5 years ago. If I'm buying stock today for the first time, I'm more interested in what I think the stock value is going to be over the next 5 years, if it's going to increase or decrease. And so again, I'm interested in trying to take whatever information I have and trying to make projections or forecasts of where the company is going. But many times the best way of making some kind of a projection or forecast for the future is by looking at trends in the recent past. For example, let's assume that, yes, at the end of this 10th year, we have assets of a business amounting to $1 million of assets. But if I told you that at the end of the 9th year, the amount of total assets was $800,000, you could reasonably conclude that over the last year, assets theoretically must have increased from $800,000 to $1 million. In other words, this company is growing. Its assets are increasing. If you were to look at, for example, retained earnings for as of the end of the 9th year, and retained earnings as of the end of the 9th year had a balance or an amount associated with it of $150,000, and retained earnings is $300,000 at the end of the 10th year, you can assume that retained earnings must have increased by $150,000 during that 1 year. Think about that. If retained earnings increased by $150,000, they must have had earnings of at least $150,000, net or less any dividends that were paid during that period. That's very significant and is a very, very positive sign. So if we can know the balance of or amount of assets in the prior year and at the end of the current year and owner's equity or retained earnings, we can start to make some conclusions. And one of them would be, hey, this company is growing. Its assets have increased over the last year. And it's clearly profitable because its retained earnings have increased by over $150,000 during the last year. And the only thing that would cause retained earnings to increase would be if it had had earnings that were retainable. What if I changed the assumptions and suggested to you that if in fact you looked at comparative balance sheets, a balance sheet at the end of the 9th year and the 10th year, and that instead of it being $800,000 of assets at the end of the 9th year, I told you that it was really $1,500,000 of assets at the end of the 9th year, and here now at the end of the 10th year, it's only $1 million of assets. Again, in both examples, the balance of assets at this moment, the end of the 10th year, is $1 million. But what's changing is an understanding of what the trend is. If in fact assets at the end of last year were $1.5 million and this year they're $1 million, this is a business that's contracting. It's not growing in terms of its asset and its capabilities. It's actually has fewer assets and then probably as a result less capacity for future growth. You see, in order for you to really do projections in the future of where you think a company is going, you need to look at comparative balance sheets over the recent past in order to see if there are any trends that you might be able to then continue or project out for the future. So comparative information year by year of the balance sheet actually provides what is almost more valuable information than just having an accurate ending balance at the end of any particular year. Now, what I want to do is I want to build a diagram with you here that kind of highlights this analysis of comparative balance sheets, similar to what I've been talking about. And we're going to do that by first identifying the basic elements of a balance sheet: assets equals liabilities plus owner's equity. And let's actually, just for the sake of explanation, understanding here, go ahead and establish some balances of amounts of assets, liabilities, owner's equity, as of a date, we'll say 12/31/X1. Now, on a real balance sheet, I would identify all of the different kinds of assets. But here we'll just go ahead and summarize and say we've got $100,000 worth of assets, whether they're cash, inventory, property, plant, equipment. I'm not going to distinguish that. We'll just say $100,000 worth of assets. And I'll tell you also, make an assumption that we have $75,000 of liabilities as of this point in time. As a result, you know or should know that owner's equity would have an amount of $25,000. Assets equals liabilities plus owner's equity. Let's also distinguish relative to owner's equity, and if in fact the amount of owner's equity is $25,000, owner's equity or owners create or provide equity to or assets to a business one of two ways, either by making capital contributions, which we may call capital stock, or by allowing earnings of the business to be retained in the business. And so let's take that $25,000 and break it down into those two categories or classifications of capital stock and make an assumption that owners have contributed assets in exchange for stock amounting to $20,000 and that retained earnings as of the end of the year, 12/31/X1, amounts to $5,000. Okay, this is just the basic elements of the balance sheet at the end of X1. Now let's do the same thing but move it a year along and say that at 12/31/X2, the total assets are now $130,000, liabilities amount to $85,000, and owner's equity has increased to $45,000. Now, again, as I mentioned before, one of the things that most investors' creditors want to do when evaluating financial statements and using them to make investment or credit decisions is they'll want to do the comparisons and see whether these assets have increased or decreased. So let's draw a line under each of these columns and then do a calculation to determine the change. We'll identify that with the sign delta during the year. In other words, the change in total assets during the year X2. 12/31/X1 is the end of the prior year, which is really the first day of the next year, X2. So the increase from the beginning of the year, $100,000 of assets, to the end of the year, $130,000 of assets, was an increase or change in our total assets of $30,000. If we'll look at liabilities, we'll see that liabilities increased from $75,000 to $85,000 over the last year. So the net change in total liabilities is $10,000 increase. The increase in owner's equity went from $25,000 total to $45,000 total, or a $20,000 increase. That is the change in owner's equity as during that current year. One of the things that I want to point out here is that just as we have mentioned that assets equals liabilities plus owner's equity, if you put a delta before each of these elements or calculate the change in total assets, any change in total assets during the year must be equal to any change in liabilities plus any change in owner's equity. And that is true here, at least mathematically speaking. The change in total assets was an increase of 30, liabilities increased by 10, and owner's equity increased by 20, so both sides of the equation are in balance in this particular case. But you can even kind of understand that, just on a more practical basis by saying this. The assets of this business increased during the year by $30,000 worth of assets. Again, the right-hand side of the equation explains to us how we got those assets or how those assets were financed. In this particular case, we had a net increase in our total assets of $30,000, of which $10,000 of that increase is attributable to additional borrowings, and $20,000 is attributable to resources provided by owners. See, we're really explaining how the growth of the company was financed. Some of it, $10,000 by debt, and $20,000 from owners. But maybe we could expand the description of the change in owner's equity, or how much was financed by the owners, by really remembering that owners provide financing or assets to a business one of two ways, either by making additional capital contributions or by allowing the additional earnings in that year to be retained in the business. What I'm suggesting is another way to describe or quantify any change in owner's equity would be that amount would be equal to any change or increase in that year in the capital stock or capital contributions, plus any change arising in retained earnings during that year. In fact, let's go back to this 1231X2 balance sheet and expand this to reflect that yes, owner's equity is equal to $45,000 at 1231X2, but let's also make an assumption that capital stock amounts to $25,000, and the total being $45,000, retained earnings must therefore be $20,000. So of the $45,000 of owner's equity at the end of the year, $25,000 of capital stock, $20,000 of retained earnings, what has been the change in capital stock? Well, capital stock started the year at $20,000 and is now $25,000, so owners must have made additional capital contributions during the year of assets equal to $5,000. And we'll simply say that the change in capital stock, or the amount contributed in the current year, was an increase of $5,000. That explains this change, or at least a part of this change, of $20,000 of owner's equity. Retained earnings also increased from the beginning of the year to the end of the year, increasing by $15,000, going from $5,000 to $20,000. This increase in retained earnings of $15,000 accounts for the full change in owner's equity of $20,000 when added to the capital stock increase of $5,000. So any change in owner's equity, in this case, $20,000 of additional resources owners have provided to the business, is attributable to an additional $5,000 capital contribution and an additional $15,000 of earnings that have been allowed to be retained in the business as a result of operations in the current year. In fact, we can even expand this equation to be a little bit more descriptive in terms of what gave rise to the change in retained earnings during the year, because any change in retained earnings during the year is as a result of earnings during that year, less any dividends from those earnings paid out to the owners during that year. In fact, net income for the year minus any dividends for the year will be the same as the change in retained earnings. Let's assume for a moment that I tell you that dividends paid out by the business during the year amounted to $20,000. If you knew that the change in retained earnings was $15,000, you could actually calculate or determine that net income for the year must have been $35,000. You see, you have kind of a little algebraic equation right here where you're talking about the change in retained earnings and then further defining that as net income for the year less dividends. If I tell you the change in retained earnings is $15,000, and that change is equal to net income minus dividends, and dividends amounted to $20,000, then net income must have been $35,000 because $35,000 of earnings during the year, less dividends from those earnings paid out to the owners, therefore not retained, leaves us with $15,000 of earnings that have not been distributed but are being retained in the business as a result of this current year's operations. Yeah, I could have kind of changed this around. If I had simply told you that net income for the year, again, given the algebraic nature of this little section of the diagram, that net income was $35,000 and dividends were $20,000 for the year, you would have automatically known that there must have been a change in retained earnings as a result thereof of $15,000. Now, we can even expand this equation a little bit farther to even be a little bit more descriptive, because we know that net income is defined as revenues minus expenses. If net income for the year was $35,000, and net income is defined for any particular year or period as revenues for that year minus expenses for that year, if I were to tell you that expenses were $185,000, you could naturally assume that the revenues for that year must have been $220,000. Because again, this is a little algebraic equation. Revenues for the year minus expenses for the year equals net income. If you know two elements of this little algebraic equation, you could always solve for the third unknown element. If I told you that revenues for the year amounted to $220,000 and expenses for the year amounted to $185,000, you would automatically know that net income must have been $35,000. It's simply the difference. And then, if you knew that dividends for the year were $20,000, you would automatically know that retained earnings must have increased by $15,000. The earnings not paid out in dividends but retained in the business from the current year operations would have increased by 15. If you knew that capital stock increased by 5,000, you could naturally conclude, because again you have a little algebraic equation here where any change in retained earnings plus change in capital stock are the only two ways that you can create any kind of an increase or decrease in owner's equity. So again, if the change in retained earnings was $15,000 and the increase in capital stock was $5,000, the change in owner's equity must have been $20,000. You can see by looking at this diagram that the income statement actually serves, and the income statement is revenues minus expenses for a period of time, that the income statement for a business for a period of time actually serves as a partial explanation of why the balance sheet changed, or at least that balance sheet associated with owner's equity. The information reflected in the income statement for the year ended 12/31/X2 actually explains why our company grew, at least a partial explanation of the growth in assets of $30,000 during the year. That is the purpose of the income statement, to explain the growth in assets or reduction of assets arising from operations, either profitable or unprofitable operations.